I'm at the Gold's Gym weight room trying to fit in with all the weightlifters. In my AirPod, I'm listening to one of my favorite autobiographies, Total Recall by Arnold Schwarzenegger. I may not agree with all his life decisions, but his rise from a poor Austrian boy to the governor of California still amazes me. And in my year, the life principles of success motivates me to work out. Don't settle for average. Strive to be the best. Don't just stand there. Take action. Do something. If you don't know how to do something, hire an expert. These principles are commonly preached by many highly accomplished and successful people. However, would you be shocked that if I was to tell you, when it comes to investing, applying these principles can actually leave you poor? Hi, if you're new to the channel, my name is Tay from Financial Tortoise, a channel dedicated to helping the standard generation master money and achieve financial security. And before I go on, if you have yet to download your free copy of the Standard Generation's Guide to Financial Security, 10 Steps to Securing Your Family's Financial Future, please go to my website at financialtortoise.com and do so. I send out weekly newsletters with some great tips on mastering your money, and I wouldn't want you to miss them. The principles of successful investing defies normal principles of life. We've been taught growing up that we shouldn't settle for average, that we should strive to be the best that we can be. But as an investor, interestingly, you can be well above average by settling for index funds' average returns. We've been taught that in times of crisis, we should be action-oriented. Don't just stand there, make a decision. But ironically, trying to fix a perceived investment crisis by taking more action is a recipe for poor returns. We've been taught that if you don't understand something, you should hire an expert, an investment advisor to help you manage your money. But in the case of investing, oftentimes you'll get much less than you pay for. And the reason why so many common successful life principles don't apply to the world of investing is very simple. The short-run performance of the stock market is random, unpredictable, and for the most people, emotionally traumatizing. There are countless studies that compare the S&P 500 or the total market index fund versus actively managed mutual funds. And results show again and again the low-cost index funds outperforming actively managed funds. And most often, these underperformance are due to investor or fund manager behavior of either market timing or pursuit of chasing hot funds. The notion that someone knows how the stock market or any given stock is going to perform in the next few weeks, months, or years is oftentimes based on unfortunate self-delusion. There are more than 200 years of US stock market history, and the long-term trend is up. And in the long run, the stock market performance has been rather consistent. But in contrast to long-term returns, short-term returns and movement of the market is quite unpredictable and volatile. I firmly believe that stocks over the long run offer one of the greatest potential returns for the average investors like you and I. But in the short run, the roller coaster ride can be quite a nightmare for those who don't understand the basic principles of the market and lack a pragmatic plan to cope with it. The bottom line is that investing has a whole new set of rules, and if we want to be successful, we must learn to play by these new rules. New rules that might make us feel like losers in comparison to the common successful principles of life we have been conditioned by. Introducing index investing, where it pays to be a loser. Index investing on the surface seems like an investment strategy that would be perfect for my special friend, Andy Dwyer. It takes very little investing knowledge, almost no extra time or effort, and no special skills whatsoever.
That's a kamikaze!
Yet, it outperforms more than 80% of all active investors, maybe even more. It frees you up to spend more time on whatever else you want to be doing instead of looking at the stock market or investing news. And while you're doing more important things with your life, your investment compounds and grows on autopilot. It really is about as difficult as brushing your teeth and takes as much time as going to the dentist once a year. And trust me, I'm not exaggerating. I am an index investor, and if I can do it, I'm sure you can do it too. And if you agree with the notion that you like to be paid to be a loser, do me a quick favor and hit that like button. It really helps with the YouTube algorithm and allows videos like this to be shared with more people. Index investing in a nutshell is this. Instead of hiring an expert or spending a lot of your brain bandwidth trying to select the right stocks or actively manage mutual funds, you just invest in good low-cost index funds like VTSAX and you essentially forget about it.
Forget about it.
An index fund attempts to match the return of the segment of the market that it is indexing. An S&P 500 index fund matches the 500 largest publicly traded companies in the United States. A total stock market index fund replicates all the publicly traded companies in the United States. A total international index replicates a broad cross-section of thousands of reputable international stocks, with a small management fee for each fund ranging from 0.04% to 0.11%. you can be invested in an index fund within minutes. And indexing, in many experts' opinion, is really one of the best ways to invest because they have and will continue to outperform the thousands of actively managed funds over a long period of time. One of the reasons why index investing is so effective is that index funds by nature are highly diversified and less risky. Diversification is the key to reducing investment risk. The fastest way to get rich overnight is to own the next Netflix. But the fastest way to lose all your money is to own the next blockbusters. To know what companies will do well or not do well is nearly impossible. However, you don't need to have a magic ball in order to get a healthy return on your investment. If you buy an S&P 500 or total stock market index fund, your investment is highly diversified and its performance will match that of the companies that the fund is indexing. Is it possible to lose all your money? Of course, but that means that all the major US companies have essentially been destroyed, and in that case, the value of your investment portfolio will be the least of your worries. Another reason why index investing is so effective is its low operating cost. Actively managed funds are known to charge anywhere between 1 to 2% expense ratios. This means that between 1 to 2% of your investment is deducted each year to pay the fund manager to run the fund. On a $100,000 portfolio, that comes out to $1,000 to $2,000 annually. By contrast, index funds are much cheaper given no person is actually managing the fund's performance. There isn't a person deciding which funds to buy or sell or when to buy or sell them. The fund simply replicates the index. As a result, most index funds have an expense ratio well under 0.1%. VTSAX and VFIAX, Vanguard's Total Stock Market Index Fund, and Vanguard's S&P 500 Index Funds have respective expense ratio of 0.04%. On a $100,000 portfolio, this comes out to about $40 annually. I will take a $40 expense over a $2,000 expense any day. And the real power of low operating costs really comes to play when you incorporate compounding into the formula. These expense ratios can net you or cost you hundreds of thousands of dollars over a period of 10 to 20 years. Cost matters, and the king of low costs are passively managed index funds. But my favorite reason why index funds are so effective is that there really isn't a need to hire an investment manager to monitor your portfolio. I firmly believe that with enough right information, any of you can effectively manage your own portfolio. When you have an investment manager, they take a huge chunk of your portfolio to manage your money for you. This is real money that is going into someone else's pocket instead of staying and compounding in your account. Some may argue that there are really good investment managers whose performance is worth the cost. Peter Lynch managed the Fidelity Magellan Fund from 1978 to 1990 and posted an average annual return of 29%. However, such individuals are so rare that some investment scholars attribute their consistent performance to luck rather than skill. Just like stocks, many of yesterday's superstar managers can quickly turn to today's underperformers. And how can you effectively identify who tomorrow's superstar will be? This too, unfortunately, is a futile pursuit. The bottom line is that with index funds, who's managing the fund is not an issue. Index funds only track the index, nothing more and nothing less. We won't know what the future will hold. However, what is sure is that when it comes to investing, more activity, more timing, and more supposed expert advice won't get us better returns. When it comes to investing, be okay with being a loser. Thank you guys for watching, and if you want to learn more about index funds and my 5 best Vanguard funds to buy and hold forever, check out my video here.